Costa, broadcasting live from the wonderful state of New York. We're not in the studios today, but we're going to give it another shot here. And in order to do that, we're going to talk about Opportunity Zones Part 2 from our last podcast by popular demand. Before we get into that, let's introduce Vicki Hutchmala from the QOZ Marketplace. Vicki, how are you doing today?
I'm great, Ron. I'm great. I'm happy that we get to start up our new podcast, and I'm happy that this is part 2 of the podcast we just did with Gerry Reihsen, an attorney with Opportunity Zones, and we're going to take it to the next level. So let's start.
Well, there you go. You just gave away the whole intro. You know, now everyone knows.
I take it back. Okay, I take it back. Let's be a surprise.
Okay, so let's do it anyway. Let's introduce Gerry Reihsen. Gerry, how you doing today?
I'm doing great. I'm very pleased to come back for a part 2. I think we can get into more interesting things about how people are using the Opportunity Zone program in creative and inventive ways.
Yes, exactly. Because the last one that we did, we were so into it, and we're like, you know what, this has got to go part 2. Usually, don't you hate like part 2s of things? Like you start watching something, and all of a sudden it's like, okay, next week, part 2. We're going to do it anyway because this is such an important information. And, again, Gerry, you're a securities attorney, and you've got a lot of experience in the industry with Opportunity Zones. And let's kind of take off where we were last time. Last time we talked about a lot of the creative usages of Opportunity Zones and maybe some of the underappreciated elements of it. But now let's get into that even more in detail with some examples and some of the things that we talked about in the pre-show.
Yeah, absolutely. So we kind of talked about entry points and underappreciated ways to get into Opportunity Zones and why people seem to have neglected it more than they ought to have last time. But this time, let's talk about what people who are getting into it, what they've been able to do, and some conceptual things that are available to Opportunity Zone investors. As you know, more than 90% of the dollars going into Opportunity Zones have gone into real estate development, operation, and ultimate sale of real estate projects.
Right.
There's one, and I have many clients that are doing 500 unit multifamily apartment complexes, or doing industrial or storage, all that institutional stuff. But I have other clients that are just people like you and me who are buying a luxury or developing a luxury rental cabin in an Opportunity Zone, and there's some around Dallas, where I am, that are just fabulous places to go for a drive vacation with the family. And one thing that a lot of these real estate investors don't know is that when you sell after a 10-year hold and you get your tax-free proceeds, you're not only avoiding capital gains tax on that sale, you're also avoiding something called depreciation recapture. And depreciation recapture happens when, as you operate a property and you produce income, you get a depreciation deduction representing a diminution of value, a lessening of value of your asset, and that's a non-cash depreciation deduction. So that reduces your taxable income in any year, but it also reduces your basis by that amount. And when you go to sell, that amount of basis reduction can be taxed as depreciation recapture. But because of the way the Opportunity Zone statute works, you move your basis all the way up to fair value, skipping both depreciation recapture and capital gain. And while most Opportunity Zone investors understand that, they don't understand that there's a way to make that even more valuable. There's a way to make that essentially deferred tax on your depreciation-based income to make it non-tax. The way to juice that is something called cost segregation. What you do is you hire an accountant or an engineer to go look at your real estate project and see what assets you have at that real estate project that depreciate faster. If you don't do that, you just get the long-term depreciation generally applicable to real estate. But if you come and do a cost segregation analysis, you allocate the cost among your various assets included in that project, most of which are going to depreciate faster. So you can get more untaxed cash flow quicker that you're never going to have to pay tax on. So cost segregation analysis, every real estate investor should look at doing that with their opportunity zone investment in real estate. That's one of the things one of the strategies that people are often missing out on.
Okay.
Now,
Go ahead. Can I stop you right now with this? When you do the
Sure.
cost segregation, you have to hire somebody to do that. Is that person accredited with anybody? Is there a certification that these guys have?
Yeah, you have to have somebody who's credible from the point of view of the IRS, but it's easy to find. I've got a lot of resources I can refer you to. For people who are doing, just luxury cabins, I've got people who do it at a cost point that's not too expensive. For people who have a big multifamily apartment complex, you would tend to get a larger institutional firm. I'm trying to remember. I've got some friends at one of the big firms that do a lot of this, but I can't pull the name out of my head right now. But, you wouldn't do it if it's not cost effective. So, but fortunately, if someone contacts me about it, I can give them some cost effective alternatives to look at.
Okay.
So, Gerry,
okay.
Gerry, what would you say is the most unique way of using an opportunity zone? Because there's opportunity zones all over the country. They're not just in depressed downtown areas of every city. They're all over the place. So tell us some unique ways of using.
Yes, so that's a great segue into talking about some of the unique things that we've done or we've seen or we've suggested. And one of the unique things is to do opportunity zone investing in things that provide tax credits, because you can get both your tax credits and your 10-year tax-free disposition, because the opportunity zone benefit goes to the investor at the very top, but the tax credits goes to what you're doing down below. And some of the areas where we've seen people do tax credits is there's one really interesting thing is the state of Ohio provides a saleable tax credit. So you don't have to be an Ohio resident to get the value, because you would sell the tax credit, of 10% of your investment in any opportunity zone deal you do. And the reason Ohio does it is because there's a competition among states for opportunity zone capital. So
that's right.
Not only did the smart states make sure that a good portion of their opportunity zones were attractive and would attract capital to the states, but Ohio went a step further and said, we want that capital from all over the country, frankly, all over the world, because there are people all over the world who are subject to U.S. taxes, to invest their capital gains in Ohio. And so if you invest in Ohio, and we've done some of these deals, when you invest, Ohio gives you a tax credit. You can sell that to other Ohio, even if you don't have an Ohio tax obligation. You can sell it to Ohio residents, taxpayers who need that credit, and all of a sudden you've made 10% of your money back immediately.
Wow.
The other,
and that's important.
That's how deals become valuable. Another thing that we did is, as you might recall, when you put your money into a self-directed opportunity zone vehicle, you can defer your taxation until 2026. We had an investor who had about $50 million from selling his business. Actually, it was a business with his mother. It's kind of cute. What they loved doing in California was investing in rooftop solar projects. Well, you get state and federal tax credits for that in California, plus the utility pays you at the retail rate, not the wholesale rate. So you make good money by having a rooftop solar project. And in Ohio, in California, the whole industry has gotten up where the solar panel installers and banks, lenders have come along, and they will fund enough of the project with debt so that you get a 1-for-1 tax credit. So every dollar you invest, you get a dollar tax credit. So, but it's, it takes a while to find these tax credits, especially when you have $50 million to spend. So he set up an opportunity zone vehicle, and every time he finds a solar project he wants to invest in, well, if it's not in an opportunity zone, he just distributes out some of what he invested then that amount becomes taxable, but then he marries it up with a 1-for-1 tax credit, so he pays no tax, and for no dollars, he gets a very attractive income stream. Or if he finds one that is in the opportunity zone, well, then he'll invest through the vehicle, and then later on, 10 years from now, he can sell that tax-free, but he has the same no-cost income stream. So that's one really creative thing that we've done. The other areas where you can combine tax credits are historical tax credits. If you are renovating a historical a historical building, well, yeah, you're going to have a very low cost for that renovation, and you're going to have a great investment that you're going to be able to sell tax-free. Also, low-income housing. The way that works, there's a couple of different programs for low-income housing, but there's one program where you get the neighborhood of $2 million or so a year in tax credits for 10 years. And the sponsors and general partners of these, they invest very little. And their investors are investors who only care about getting the tax credit. They don't care about how the property works out. Of course, the sponsor and general partner wants it to work out well. But after 10 to 15 years, those tax credit investors have gotten all their investment, and then the general partner gets the whole project for very little investment. And if they've done that in an opportunity zone, that general partner now has an asset that they can sell at any time because it's already been 10 years, tax-free. What a boon for low-income housing investment.
And you couple that with it appears that it comes down to strategy. If you have the ability to generate capital gains, you have to strategize the best way to use that with the best people to help you. Why make a little bit when you can make a lot?
Just to go through other tax credit arrangements, I mean, you get tax credits. So I had a guy who came in and wanted to do a small solar plant, a whole plant, and so you get solar tax credits for that. And he was doing that in an opportunity zone. You get tax credit for carbon sequestration. So you can create a vehicle that takes carbon from the air and buries it in the ground, injects it into the ground, or other ways. But not only are you getting the cost of that refunded back to you in respect of tax credits, now you're also generating carbon credits that you can sell, and you can sell the whole thing after 10 years tax-free. So you can marry a bunch of other great benefits. I mean, you can get grants, and there's programs under which you can grants and other things to really juice opportunity zone investing. So that's one area. You can combine Section 1202 venture capital investing with opportunity zone investing when you're setting up tech companies or other companies. Really, so now you're pulling in Silicon Valley type investment as well as getting your tax-free upside for those who invest through the opportunity zone structure. 1202 is a statute which allows for venture capital investors in certain size companies to avoid, after a 5-year hold, the greater of $10 million of capital gains, or essentially 10 times their investment. So that's another creative way to use the opportunity.
That's significant.
Yeah. Some of the really interesting businesses that we've seen created is, for instance, a gold mine. There's a group out there, and I haven't worked with them directly, although they seem to send me an email. I've spoken with them, and they send me an email at least once a week. They have created a gold mine in an opportunity zone, a qualified opportunity zone. And the reality is that, and very similarly, I've also worked with clients setting up cryptocurrency mining. The reality is that the income produced from mining gold or mining cryptocurrency is ordinary income and is not going to be getting a benefit. But as an overall business, after 10 years, you can sell it tax-free. Also, after 10 years, you can hold back some of that gold or some of that cryptocurrency for investment purposes. And then let's say you hold it for a year and your intent is to hold it for investment purpose. If you can sell that gold at a price higher than you paid income tax on it to generate the ordinary income, that's going to be, you can sell that tax-free. So really interesting creative stuff. And that applies to a lot of my clients who do self-directed opportunity zone vehicles. So I tell them, look, one of the great reasons why everybody should have a self-directed opportunity zone vehicle, like everybody should have a Roth IRA, is that once you have held that vehicle for 10 years, the holding period of the assets is not relevant, right? It's only the holding period of the structure. So let's say over 10 years, you built qualified assets of $10 million. Well, every year you could buy a fleet of rental cars, of a fleet of cars you want to rent under two-row, for instance, which is like Airbnb for rental cars. You have to do it in a compliant way, so it can't be all your assets because they're not necessarily going to be qualified assets, but you get to have about 30% of your tangible assets not be qualified assets. And then you can rent those out, take depreciation, which helps reduce the taxable income you're producing, and after a year or two, sell them on a depreciated basis without having to pay tax on the recapture of that depreciation and buy another fleet. You can essentially asset churn after 10 years for income producing assets.
Yeah, and this is over and over again.
And you can do that over and over and over until the end of the statute in 2047.
Jeez.
So that's another creative use of the opportunity.
Yeah,
So the other really creative things, we were involved in a urban farming business that was buying up empty, old warehouses and stuff and renovating them and operating businesses that provided locally sourced lettuce and whatever else. And, as that business grew, after a 10-year hold, and that business is a growing industry, they can sell out as to someone who's rolling up those kind of businesses and not pay any taxes on that sale.
Yeah. We know somebody in northern Nevada who was putting in a shrimp farm up there in the desert, which was very interesting in opportunity zone. It's like, if you can think it, I guess you can make it happen. But growing shrimp in the desert was kind of odd, but it was an opportunity zone.
I wonder if the shrimp from the desert has a different flavor than a shrimp from the ocean.
They might. They might be a little more. They might have a little bit more tan to their color.
Yeah.
Maybe so.
Yeah. Hey, Gerry, what about biotech companies and things like that? About pharma, they must love this kind of stuff too, right?
Yes, there are people in the space. So there are a few venture capital firms structured under the Opportunity Zone statute, and they're investing. Biotech is a popular investment that they make under their Opportunity Zone fund. I assisted a company who had developed a brand new way to, in a more efficient manner, produce chemical compounds, including pharmaceuticals or industrial chemicals. And I set them up a subsidiary to be a qualified opportunity zone business, which could then take investment from qualified opportunity zone funds and capital gains investors. So yes, any attractive businesses that you have high confidence level that you'll be able to sell after 10 years for a capital gain is a great thing to look at for these types of things.
Yeah. So how about like entertainment companies, like guys who always want to crowdfund for their movie project or do things like that? Is there a use for that?
It's a little harder because you have to have a nexus to an opportunity zone. So if you have a studio, there are movie studios that have been put up in opportunity zones, and we also worked with a group that was doing a combination historical tax credit theater production dynamic. So as long as you can have your nexus of having the appropriate amount of your tangible assets in an opportunity zone and you generate or deem to generate 50% of your annual gross revenue from an opportunity zone, you can make it work. We can make just about anything work. The easiest things to make work are low asset companies, service companies, law firms, accounting firms, property management firms, asset management firms. Low asset firms are very easy, and we can easily reincorporate them as well, even if they're not currently operating as an opportunity zone business.
No,
Yeah.
So that works really well.
Yeah, one of the things I really like about this whole opportunity zones thing, we talked about this so many times, is when you're in real estate and you want to do something, basically your 1031 is your option. And the opportunity zones project, as we've seen in this podcast so far, you can basically do with anything. I mean, this thing is incredible in that manner, right? I mean,
anything.
Amazing.
Any capital asset you sell generates the type of equity that you can use, and you can invest in any business essentially. There's ostensibly some, quote, sin businesses you can invest in, but as I've said in prior podcasts, we can find a way to structure around that. So I was going to say something else.
I would imagine the Ron fund at the crap table probably wouldn't work, right? That's not good.
That's a really interesting question. Well, number one, I think it actually could work. If you set up a business in Vegas and the business was to try to make gambling proceeds, we could make that work. And the gambling proceeds that you generate would be ordinary income. But if you could create a reliable income stream so that somebody would buy that business from you after 10 years, we could set it up so you could sell it tax-free. Yeah, we could do that.
Okay, you know what?
Now,
that answer alone makes me go for Gerry Reihsen 2024. I'm doing it.
I'm backing you.
I got to tell you something really interesting.
I'm sorry, whether you're running or not, I'm backing you as a result of this podcast.
Well, remember those guys from MIT who found a way to win every time at blackjack? Remember those guys? That business.
Oh, yeah.
And they did it for a while before the casinos caught on. That business could have been set up as an opportunity zone business. But it wouldn't have been in business long
maybe
enough
in New Jersey
after 10 years.
Yeah.
Maybe New Jersey.
Maybe in New Jersey, not Vegas. Vegas wouldn't allow that to happen.
Yeah.
That's right.
But you're right, Gerry. You can do anything with any business.
Well, but it's not just that. I want to tell you something really interesting. So we have a lot of clients. We have a lot of clients who invest in an area of southeast Oklahoma where Texas and Arkansas and Oklahoma meet. And believe it or not, on the eastern part of Oklahoma, there are beautiful mountains and streams. There's fly fishing. There's river rafting. There's lakes. It's unbelievably beautiful. It's before you get to the Ozarks, but it's kind of part of the Ozarks in a way. And people from Dallas drive up there. And almost this entire county called McCurtain County is an opportunity zone. And it's become a vacation spot where people are building both commercial entertainment venues and building luxury cabins. There's a brand new Choctaw Casino going up there. All those things we've set up for our clients as opportunity zone investments. Others are not bothering to. Don't ask me why. But guess what? All of that was going on in an unincorporated area. And now the main area is built up so much that they've incorporated the city. And we're talking to the city about having opportunity zone investors provide the capital to build their sewage plant, to build their other infrastructure. And then the city would buy them out after 10 years for a stated IRR. And so you don't even have to have a business. You can have a business that creates municipal infrastructure. Just the amount of the things you can do is just way off the charts.
Yeah, that's
my God.
It's absolutely amazing. I do have a question though, Gerry, before we close out this podcast, and it's basically on a very top level. Whereas you create an opportunity zone, let's say fund for all this stuff. How do you know that your fund is created correctly? I mean, you don't want to go through years. All of a sudden, the IRS says this is wrong at the beginning, right? How do you know?
Well, I don't even know if my taxes get filed correctly, right? I give them to somebody and they file them. I look at them, they seem right. But I give them to an expert. So the good thing from my perspective is that I've been in this thing since it first started. I was part of the rulemaking process, wrote comment letters as the rules were going through, was in conference calls with the guys who were making the rules, the IRS. You need to hook up with great attorneys and great CPAs and tax advisors who've got the experience from the front end, who can structure it right for you and explain it to you as you go along. But it's your job as an investor is not to know every detail of tax and corporate structure and securities laws. Your job is to create a great business concept and pursue it in partnership with your attorneys and CPAs and compliance officers. So I've never seen anybody self-help themselves correctly, right? They always messed it up. It's not that complicated to get it right if you know what you're doing, but you can't get it right if you don't. I've saved a few of those, restructured them in time before it was too late. But for instance, I had a client, or almost a client, who came to me to talk about opportunity zones up in that McCurtain County I was talking about, that Broken Bow, Hochatown area. And he came in and said, hey, just want to see, I called the state and they told me this is an opportunity zone. So I built my luxury rental cabins there. And so I'm going to get tax-free upside. So just wanted to chat, see if there's anything. Well, he'd set up entirely wrong. He's not going to get any tax-free upside.
Yep.
And when I told him, what the issues were, he basically just quit talking and said, "Oh, I will too," and he went off on his way.
Yeah, I see that a lot. That's a very common example. In fact, a while back, Gerry, we did a podcast and we titled it "You Don't Know What You Don't Know," and that's exactly right. People think they know everything, and it's very, very, very bad outcomes many times. So,
well, I greatly respect people who just go in and do, right? Go in and do.
Yeah.
This is not an area, though, where if you just go in and do, you're going to get the tax benefit you want. You may have created a great investment. You may have created a great rental cabin. You may have created a great business. By the way, one of the businesses up there in Broken Bow, right along the main strip, has created a maze, a human maze, just with wood. What a great way to not put a lot of money into an investment, make some current income while you wait for that land to increase in value as more and more. So that's another strategy, is you have to improve your real estate, but when it's just raw, you only have to put like 10 or 20% of the cost of real estate into it. And if you do that and run a business on it, you're actually got a real estate investment. It's not land banking. That's not permitted, but it's close to that. So land banking, in a way, taking advantage of the increase in real estate in a hot area is another thing that we've done. But just digress on other creative things.
Yeah, no question about it. So we talked about getting in touch with a professional and a securities attorney or somebody that knows all this stuff. And luckily enough, we are actually talking to one here with you. So why don't you tell everyone how to get a hold of you and the best way to reach you?
Yeah, well, I'm sure you're going to put it down in the notes, but my email is GREIHSEN at swordshieldlaw.com, SWORDSHIELDLAW.com. And you can just call me as well as at 214-908-2009. And, like I say, I know fabulous CPAs, tax lawyers. I'm a securities and business and structuring and transactional lawyer who know the space and can be relied upon to help you get these things done correctly. And
Vicki, I gotta say, the part one and the part two that we did here with Gerry just blows my mind in terms of the information that we've got and the potential and stuff that we never even thought of before. Do you have any other comments or questions you want to ask Gerry before we close this out?
You're absolutely right, Ron. And I tried to pretend that I didn't know anything about opportunity zones to see if Gerry could really wow us or, Oh, my God, Gerry. How exciting is opportunity zones? I mean, like I said, they were exciting when we first knew about them. Now they're even more exciting because there's so much you can do. You just have to have a creative mind that can strategize, that can take you to where you want to go. And Ron and I, one of the things we try to impress on our listeners with all of our podcasts is no matter what you're doing, no matter what you're trying to approve, you will not be successful unless you hire expert advisors, consultants, and professional people who know what they're doing, who can help you. A lot of people think, oh, well, that's not so bad. I can do it. That's easy. And they want to save the nickel they don't want to pay the fee. And then they find out, oh, well, I just made such a big mess. It's going to cost 2 or 3 times as much to fix it because I messed it up. When if I was just smart enough to hire a professional, hire an expert, make the money, everybody would be so much better. And Gerry, this is why you're one of our favorite guests on the podcast, because you're such an expert, you're so passionate about what you're doing, and your purpose is to help people take advantage of the opportunity zones like they could in the right way. It was such a pleasure. It was such a pleasure, Gerry, to do our first new podcast with you, because you always bring something exciting to the table. And you wowed me, Gerry. Now I'm even more impressed with opportunity zones. Thank you.
Well, you're very welcome. It's always a pleasure to be on your podcast. You're a great host, fabulous people. So I appreciate it, and thank you very much.
Yeah, thank you, Gerry, and maybe we'll discuss this in more detail. We'll discuss the Ron Fund in more detail when you come to Vegas and Swift and Craps. And there you go. But thank you so much.
Yeah, I want to see that happen.
Yeah, I think that'd be fun. I think that really would be pretty cool. Anyway, Vicki, thanks for co-hosting this episode. And folks, you're listening to the Mappable USA podcast at MappableUSA.com. If you go to that website, you scroll down, you see all our syndication sources. Pick the one you like best and subscribe, and you'll never miss another one of our episodes. And if you want to be a guest on the show, like Gerry was today, then just fill out the guest tab. We'll see what we can do about getting you on the show. And if you like what you heard today, send us an email at info@MappableUSA.com. So thanks for listening. Thanks for your support. We'll be at you next time with another Mappable USA podcast. Have a great week, everyone.